Hello, everybody. Welcome to Talking About Houses. I'm Todd.
I'm Oana.
Okay, so today we're going to talk about the job growth numbers that came out, and the inflation, a bunch of things like that. But what's cool is this is brand new information, and we're going to talk about how this affects the housing market.
Right.
Okay, so I'll put up the first slide here. We have a whole bunch of slides, so you have to be patient today. We have a lot of slides to get through. U.S. job growth remains solid in June, so this is July of 2022. These are brand new job growth numbers. The hotter than expected labor market eases worries of an economic slowdown, but complicates efforts to fight inflation. So let's talk about job growth in general, because people have been talking about they're just seeing all these reports of job losses, and people are worried about how that's going to affect the housing market.
Right. Well, the economy churns jobs all the time. Okay. I mean, people come, people go, companies grow, companies shrink. This happens all the time. And it's just a natural cycle in the economy.
Right. Okay, so we're going to start with the unemployment rate. Now, the unemployment rate on this chart was for May, 3.6. To put in perspective, this goes all the way back to the 80s. You can see historically the unemployment rate is normally between 4 and 6%. That's kind of like the long-term unemployment rate. It went up when the housing market crashed last time, up to about 10%. Most of those jobs were construction jobs, right? There was a lot of industries taken out. Real estate, mortgage, construction, like those industries were decimated.
They were. And you're also looking at the peripheral industries that kind of feed off of those. So it was a large segment of the economy, hence we had high unemployment.
Yep. Okay. Now, as you can see, as we get closer to today, all the way to 2020, the unemployment rate just started falling. Of course, a lot of this was easy economic policy, easy money. Companies were able to gain access to capital and grow, and there was a demand for labor. Then you see the spike that was probably started March or April of 2020, which was the thing known as COVID. Unemployment went up to 15%, and these were mainly like restaurant jobs and people that were like, hey, we had to close. So certain businesses had to close.
Right. So it was a combination of things. Certain businesses had to close because they weren't allowed to be open. There were other businesses that saw this as an opportunity to go ahead and get a little bit leaner because they had less overall customers, or they figured out different ways to function. So there were a lot of things going on, and that did cause a significant spike in unemployment at the time.
As you can see here, though, the unemployment rate has come back down to 3.6%. That's the May number. We're going to talk about the June number and then kind of going forward. What's really interesting is, so people have been saying that the rising unemployment is going to affect the housing market, because that's what we're talking about, right? However, now this is Federal Reserve estimates, okay? They're estimating the June 2022 estimate is that they have 3.7%. That 2023 will have 3.9%, and in 2024 we'll have 4.1%, and long run about 4% unemployment. Really, there's nowhere in the Federal Reserve's estimates for unemployment is there high enough unemployment that would cause what people have been talking about, which is, how are people going to make their mortgage payments when they lose their job? Because we've got more detailed numbers that are really going to blow people away that we're going to talk about after this. But we think about, like, where is this rampant unemployment? Because people have been talking about recession, and they've been talking about unemployment, and we're going to get to recession in a second, but unemployment right now looks pretty low, historically low, like the lowest it's ever been. Highly, highly unlikely for that to cause significant problems in housing.
Right. So we've discussed this before. We do have low unemployment, and yes, we do recognize that the unemployment numbers are a little bit skewed because we have a number of people that have simply opted out of the job market altogether for whatever reason. They've either retired early or chosen to make other lifestyle choices and not be employed. But I think one of the things that people have also chosen to do is not work for someone else. And I don't think that these unemployment numbers are really looking at the entrepreneurs out there. And I think that's something that I don't think that the numbers are set up to gauge.
There is so much money flowing into venture capital and private equity to fund these newer startups, which are churning out old inefficient companies. we've seen it all the time. The perfect example is what Amazon did to Barnes and Noble.
Right.
People, when Amazon first came out in the 90s, people were like, there's no way this will replace any, it's like what Netflix did to Blockbuster. They won't replace them. They're not. And they just made it more efficient.
Right.
And they were able to do something more efficient and actually what they did is it created higher paying jobs because they created tech jobs, right? Okay, so unemployment's low. We have more unemployment stuff, but we're going to talk about chance of recession here because the other thing that people are saying is, well, it's the recession. The recession is going to cause a housing market, and there is a risk of recession because the interest rates are pretty high, right?
Yes, I mean, we can all acknowledge that, we've got negative economic growth. We're all acknowledging that. We're not saying that that's not happening. It is happening. But there are other pieces in the economy to consider because the economy is far greater than just that.
Okay, so Financial Times did a survey of 32 economists.
Mm-hmm.
What do you think the chance of inflation in the U.S. are in the next couple of years? 2% said this year. 2%. This is this is new data. This just came out this was basically they interviewed people in June. 38% said we think the beginning of 2023 there could be a recession. But of course, these are economists and they could be wrong. The 2%, we could have one this year, we could not have one this year. 30% said the end of 2023. So most economists still think the risk of recession is still like a year in the future.
Mm-hmm.
And we've been sort of waiting since 2019 for this housing bubble to pop, and all the things that have said we're going to pop it, literally haven't happened. And this is potentially another thing. So I think people trying to make a decision in the next, should I wait 6 months to buy because the housing market's going to collapse because of this recession that's going to happen this summer? Well, this chart is pretty interesting when you look at what economists think is going on with the economy.
Right, it is. And it's interesting from a seller standpoint, too. We know sellers are nervous out there, but the thing is, people still have to live somewhere, guys. So you're selling your house, somebody needs a house. So your house will sell is what I'm trying to tell you. Your house will sell. It's not going to sell for pennies on the dollar. You will be fine.
Oh, really quick. We have data for video that's going to come out tomorrow. And so make sure you subscribe, hit the notification bell to see that because that's all the sales data. Mm-hmm. You're going to be shocked at the sales data because people are talking about all these negative things happening, saying, oh, the market, somebody posts on the video, oh, somebody reported that home prices in Vegas have already fallen like $30,000. They reported it. And I'm like, really? Because we're not seeing that anywhere. Are they telling you the market's going to crash? You should list your house with them before it crashes because, that's. But anyway, we got the sales data. This is actual data. This is the most current data. We're going to put this video out tomorrow, so you need to subscribe.
Yes.
But we're going to go back to this. Now, here's the important thing. Mm-hmm. Why all these people saying, wait, but I read articles that said some people laid off and some other companies laid off and all these people laid off couldn't pay their mortgage. That's most of the comments on the videos are how are people that have lost their jobs they're forced to sell. That's the concern, right? Okay.
So what happens when you lose your job? Well, when you lose your job, you tend to go look for another job. And in a market where your skills are desirable, you're going to get another job. Will it pay the same? Maybe, maybe not. But the pay differential is unlikely to be substantial enough to cause you to not be able to afford your 3% mortgage. Because remember, that's what most people out there have, they have those 3% mortgages. So please keep that in mind. Your 3% mortgage, your mortgage payment is less than what you would pay in rent. So it is highly unlikely you would be forced to sell.
Okay, here's the magic thing. The jobs number just came out for June. Mm-hmm. The U.S. economy added 372,000 jobs in June. Mm-hmm. This is net jobs. This does not mean we lost some jobs, we added some jobs. This is net job. There are 372,000 more jobs than there were in May. The economy is kicking butt. Even though we have some inflation, even though mortgage interest rates are high, the other thing to make sure you subscribe and watch that video tomorrow, when you see what the trend is in mortgage rates, you're going to also be blown away. There's something pretty incredible happening. Strong demand for workers is also evident in the 11.3 million jobs the employers had open in May. So open jobs were 11.3 million. That is close to record high, and it's 2 jobs available for every person looking for a job. So if you took the unemployment numbers, that's like 5.5 million people.
Right.
You have 11 million people, 11 million jobs open for 5.5 million people. So if somebody says to you, hey, the market's going to fall because the recession is going to cause job loss, they're like trying to connect the dots, right? They're just trying to make a decision. Right. Well, recession, job loss, can't make mortgage payment, I still don't understand forced to sell. Like your mortgage isn't contingent on you having that job. You know, the mortgage company doesn't call and say, hey, we found out you lost your job, but you have to sell the house at a loss and get rid of that 2.5% interest rate and your $1,200 mortgage payment, right? And go rent. Okay? What do you think about this one? There's so many jobs because these jobs literally just came out.
Right. So, we do recognize that these jobs are not necessarily a match for the 5 million people out there that are unemployed. So there is that connection right there. But the point is that there are jobs out there, which means that the economy is doing fine for the most part. Jobs are being created. Companies are growing. And yes, there's always going to be movement.
So then the next thing is going to be, but these are lousy jobs. These are terrible jobs. Well, the wage numbers came out today too. This is all data from the Fed. Okay? Wages climbed 5.1%, a still rapid pace as Fed awaits slowdown. So wages are going up. We have more jobs. Yes, we have high interest rates, but this is one of the things. These are 2 of the huge things that really affect the housing market.
Right.
Wages going up and high employment. And the other thing too is, remember, with all these job openings, people can pick a better job. Like you could say, hey, I have this job that pays $20 an hour because I'm a visual designer, but this other company's paying $23 an hour. It's $6,000 more a year in pay. Maybe with that much more money, I can go buy a house or something, right? So they go and they look around. They go, I'm going to move to a company because it has a higher pay.
Right. So, with people's wages growing, that also enables them to have a little bit more flexibility regarding their expenditures, including their mortgage payments. So these high mortgage payments that are not necessarily historically high, they're actually historically really low still, relatively speaking, are still something that people can afford.
Yeah, so we have today, not looking forward, just reported, we have the lowest unemployment ever, the highest employment ever, 11.5 million jobs out there with only 5 million people looking for jobs. And the economy is predicted to have not more than about 4% unemployment for the next 3 years. Prediction for the housing market, Oana. What does this look like absent some really ridiculous thing?
Stability.
Stability.
That's really the short answer, is stability. No, we're not going to continue to have 20% appreciation on real estate. That's not natural. That's not normal. Okay, if you experience that as a homeowner, congratulations. That's wonderful. But that's not the way real estate goes. Remember, traditionally, real estate will appreciate like 5% a year. So that's kind of what this is going to turn out to be. Now, over time, it may be that there will be some price corrections in certain markets, and that's normal and that's natural. But over the long game, because remember, real estate is the long game, it's not day trading. Over the long game, real estate appreciates about 5% a year.
There are people, now, first of all, we're not pushing people to go run out and buy a house. We're not saying that.
And we're not pushing people to go out and sell a house.
We're not pushing anybody to do any specific transactional thing. All we're saying is that if you waited last year because you thought home price, and this, because we saw this happen before, people waited. If you saw people wait in 2021, the beginning of the year, because this isn't sustainable, these are going to fall, and then you've waited till this year, and now there's openly people doing videos, Facebook posts, and other things stating the market will crash, homes will be half as much, you should wait a year and then go buy a house. That's what I actually heard an agent say. I've advised all my clients to sell their houses. They're selling all their investment properties. We're going to hold on to the cash and we're going to come back in a year when home prices are down half and we're going to buy twice as many houses as we had. And I'm like, you really told them that? Like, that's pretty interesting because I don't know what is going to happen with home prices, but I wouldn't advise somebody based on what you think, or they watched a video and they think that's going to happen, right?
Right. You know, what concerns me is all these people who are out there telling people to sell their investment property, sell their primary residences, sell whatever. And my question is, have you sold yours? Because if you haven't sold yours, then don't tell me to sell mine.
Yeah.
We've been very upfront about that. We are not selling anything. And we're not saying you shouldn't, but we're just saying, look, whoever's telling you whatever that they want you to do, ask them what they're doing with their properties. And if they're doing something different, then that should give you pause. The right time for you to buy a property, the right time for you to sell a property is contingent on you, not on other external things. And that's, I think, the primary thing to keep in mind. I see this all the time where, you know, the people who are making money are the people who are having you engage in transactions either to buy or to sell, because they're making money whether you're buying or selling. They're not making money if you're not doing anything. And that's really the biggest issue that I see out there. Make your choices based on your particular situation, not based on somebody wanting to make a buck on your transaction.
The other thing is that I have heard anecdotally are financial planners telling their clients, sell all of your real estate. It's all overvalued. Rent and put all of your money into your account, which I manage for a 1% fee, you know, because that extra 1 or 2 million in real estate is 10 or 20,000 bucks a year in my pocket for fees I get to collect from you because I'm managing your money. So just be careful about that, because we don't give investment advice, but I'm just saying you should probably have some stocks. You could probably have some real estate. You shouldn't just completely bail out of real estate, just like you shouldn't completely probably bail out of the stock market. And nobody can predict what stocks should be like in a year or 2 years or 10 years. I believe in real estate. If you look historically, it's hard to beat what real estate has done. It's the safest, best asset classes. The last 15 years has been the best asset class overall. People have said it's the best investment. Right.
So do whatever's right for you. Please leave us comments. Hit the notification bell. Like Todd said, we're going to have an awesome video tomorrow. That has lots of charts, lots of numbers. Very exciting.
If you're going to buy a house in Vegas, if you decide you want to, reach out to us. One of our buyer agents on the team will take you out and help you find a house. If you need to sell a house in Vegas, then give us a call. That's what we do. We represent sellers as listing agents. Oana, what if they need an agent anywhere in the country for either one of those? What can they do?
Then you can still reach out to us, and we have a network of fantastic agents across the country that would love to do a great job for you. Whether you're buying or selling, we've got great agents that are going to be able to help you and treat you the way you want to be treated.
All right. We will see you on the next video.
Bye.
Bye.